Welcome back, everyone. This week felt calm on the surface, but the drivers underneath were anything but. Today we will hit the jobs, shock, rate cut expectations, geopolitical oil risk, and a big housing policy curveball. So let's start with the biggest story of the week, the U.S. jobs report. December payroll growth came in at just 50,000, a big slowdown that capped the weakest year of job creation since the pandemic era, while the unemployment rate still ticked down to 4.4%. Now here is what matters. Soft hiring without a spike in joblessness screams late cycle slowdown, not instant recession. But the market read it as a reason the central bank can stay patient, and that kept the risk on mood alive. So what does this mean for us? The path to rate cuts got pushed further out, and every data print now has to confirm whether this is a gentle cooling or the start of a sharper downshift. Let us look at Treasury yields, comparing the 2-year and the 10-year. After the soft jobs data, the front end moved first, with 2-year yields easing as traders priced less urgency for further tightening. The 10-year, however, stayed more stubborn, reflecting inflation uncertainty and heavy issuance pressure. That kept the curve deeply inverted, a classic late-cycle signal the bond market refuses to ignore. This gap tells us the market believes growth is cooling but not collapsing. And that tension between short and long maturities is exactly why rate expectations have become so jumpy again. U.S. equities finished the week at fresh record highs, but it did not feel like pure celebration. The rally looked like a tug-of-war between cooling growth signals and the hope that inflation and rates will keep drifting the right way. But here is the key point. When indexes grind to new highs on mixed data, it often means positioning is cautious and headlines can move the tape fast. So what does this mean for us? The market mood was upbeat but jumpy, with traders constantly repricing the same question, soft landing or sudden break. Another headline rattled markets this week, and it came straight out of housing policy. A sudden push to intervene in mortgage finance caught bond investors off guard. The message was clear: housing is back on the macro radar, not just a side story. Look at how the 30-year mortgage rate rides the 10-year Treasury but never hugs it. When the 10-year yield lurches higher, mortgage rates usually follow fast, and when the 10-year eases, mortgages tend to come down slower because the spread can stay sticky. That gap is the market screaming about duration risk, prepayment uncertainty, and plain old MBS nervousness. In a week where policy headlines start messing with housing finance, that spread is exactly where traders look for distortion and stress. And when volatility picks up, lenders and investors often demand more cushion, keeping borrowing costs elevated even if treasuries catch a breather. Energy markets suddenly snapped to attention as geopolitical risks pushed oil higher. It was not just a commodity move, it fed straight into inflation nerves and rate sensitivity. The market stayed constructive, but energy clearly re-entered the conversation as a potential spoiler. Here is where the energy shock becomes visible. Both WTI and Brent moved higher, but the spread between them also tells a story about regional supply fears versus global demand. Brent stayed especially sensitive, reflecting how international shipping routes and geopolitical flashpoints feed directly into pricing. This matters because Brent often anchors inflation expectations outside the United States. When both benchmarks rise together, it signals broad risk repricing rather than a local bottleneck. Markets did not panic, but this chart shows how quickly energy can re-enter the macro conversation. Even short-lived spikes like this keep central banks and bond markets on edge. Economic data painted a split-screen economy. Manufacturing stayed in contraction with the December reading of 47.9, while services looked far stronger, with the December services reading of 54.4. Now, here's what matters. That combination supports the soft landing story, but it also raises the chance that inflation cools slowly because the services engine keeps running. So what does this mean for us? Traders were forced to hold two ideas at once. Growth is slowing, yet demand is not dead. Another undercurrent this week was trade policy uncertainty lingering in the background. It did not dominate headlines, but it quietly shaped inflation and rate expectations. Markets stayed optimistic, yet clearly aware that tariffs remain a wildcard. Look at this CPI chart, headline versus core on a year-over-year basis. When headline inflation cools but core stays stubborn, markets get nervous because the last mile is always the hardest. That is exactly why tariff talk matters, because new import costs can leak straight into goods prices, even if energy is behaving. And if tariffs get rolled back, it can cut the other way, easing price pressure and changing the path for rate cuts. Either way, this chart is the warning sign. Inflation is not a single number, and policy headlines can still whipsaw expectations. Now zooming in on the chart, this is SPY, the ETF that tracks the S&P 500, and the big takeaway is that the long-term trend is still bullish. You can see the golden cross context on the daily time frame, with the 50 days staying above the 200 days, which is basically the market telling you the uptrend still has the wheel. So, even after a week of noisy macro headlines and rate expectations whipping around, buyers kept this thing pinned in a strong posture instead of breaking down. But here is the key point. When the bigger trend is up, the market can shrug off bad news for a while, yet it also gets more fragile to the next surprise that hits inflation, yields, or risk appetite. This ties back to how SPY spent the week pressing into the upper part of its recent range, repeatedly closing near the highs instead of fading. That behavior lines up with a cautious but optimistic mood after the jobs data, where investors were not panicking, just selectively adding risk. But here is the tension. When price hubs the top of the range like this, especially well above the 50 days moving average, it signals confidence while also setting the stage for sharper reactions if the next macro surprise disappoints. At the same time, the short-term momentum is starting to flash a yellow light, with SPY showing an overbought stochastic reading on the daily chart. That does not mean the market has to crash, but it does tell you upside is getting harder to earn without a pause. In a week where investors were calm but clearly sensitive to data, this kind of signal fits the mood perfectly. Confident trend, thinner margin for error. Meanwhile, the RSI divergence on SPY is where things start to feel a little uncomfortable under the surface. Price kept pushing higher this week, but momentum failed to confirm it, which is classic late-stage behavior in a stretched rally. In a market that is confident but clearly on edge about rates and inflation, this kind of divergence is less a sell signal and more a warning that upside is no longer free. Stepping back, the trend channel is what keeps bulls confident despite all these warning signs flashing. SPY is still holding cleanly inside that rising channel, which tells you buyers are defending dips instead of panicking out. In a week defined by cautious optimism, that structure matters because as long as this channel holds, the market bias stays up even if volatility suddenly wakes up. Switching gears to QQQ, this is the ETF tracking the Nasdaq 100, and it tells a slightly different story under the hood. The golden cross remains firmly in place, with the 50 days moving average holding above the 200 days, keeping the primary trend pointed higher. But after a strong start to the year driven by mega-cap leadership, momentum here feels more selective as traders digest rates and growth expectations. So, while tech is still leading, it is doing so with less enthusiasm than the price alone might suggest. Looking closer here, QQQ is still comfortably holding above its 50 days moving average, which tells you dip buyers have not stepped aside yet. That technical support mattered this week as traders reacted to shifting rate expectations without dumping growth exposure outright. The message is clear, tech leadership remains intact, but it is being defended carefully rather than chased aggressively. What stands out next is the range expansion day on QQQ, which shows buyers were still willing to step in aggressively on strength. That kind of move usually reflects confidence, but coming after a long run, it can also mark a short-term exhaustion push. In the context of this week, it fits a market that is optimistic but increasingly sensitive to any shift in rates or inflation expectations. Adding to that, the stochastic on QQQ has rolled over from overbought territory, which is a classic sign that momentum is cooling. This does not kill the trend, but it does tell you that chasing breakouts here comes with more risk than it did a few weeks ago. In a market that stayed optimistic yet increasingly selective this week, this signal reinforces the idea that tech gains may need digestion before the next push. One more layer to this is the rising trend channel on QQQ, which is still holding cleanly despite all the momentum noise. So, as long as price stays inside that channel, the broader tech trend remains intact even if pullbacks get sharper. In a week where optimism stayed alive but nerves were clearly creeping in, that channel is the line separating healthy consolidation from something more aggressive. Shifting focus to DIA, this is the ETF tracking the Dow Jones Industrial Average, and it shows a steadier, more defensive version of this rally. The golden cross on the daily chart remains intact, with the 50 days moving average firmly above the 200 days, signaling that the broader trend is still constructive. During this week of mixed data and cautious optimism, money rotating into these names made sense as investors balanced growth exposure with stability. The takeaway here is simple. While tech grabs the headlines, the Dow quietly confirms that risk appetite has not collapsed. From a technical angle, DIA continues to respect its 50 days moving average with no real signs of stress beneath the surface. That kind of price behavior mattered this week as investors leaned into stability while still staying invested. It reinforces the idea that the rally was not just about chasing growth, but about staying positioned without taking unnecessary risk. On top of that, the MACD histogram on DIA is still positive and expanding, which tells you momentum has not rolled over yet. That strength matters in a week where investors were clearly weighing growth risk against economic uncertainty. It suggests the Dow side of the market remains a stabilizer rather than a source of stress. By contrast, the stochastic on DIA is starting to cool off as it exits overbought territory. That is not a bearish signal by itself, but it does suggest the Dow is shifting from momentum-driven upside into consolidation. In the context of this week, that fits perfectly with a market that stayed constructive, yet increasingly aware that upside needs breathing room. Turning to IWM, this is the ETF tracking the Russell 2000, and it finally showed signs of life this week. The golden cross context is in place, and price pushed to its highest close in weeks, signaling renewed interest in smaller companies. That move lined up with the market mood after the jobs data, where slower growth did not trigger fear but encouraged rotation to overlooked areas. The key takeaway is that small caps waking up adds fuel to the cautious optimism story, but it also raises the stakes if macro conditions suddenly tighten. To wrap this section, the trend channel breakout on IWM is the clearest signal that small caps are trying to change character. Price pushing into a higher regime suggests risk appetite is broadening, not narrowing. In a week defined by cautious optimism rather than fear, this is a bullish development, but one that absolutely depends on macro stability holding together. Shifting to crypto, this is Bitcoin, the largest cryptocurrency, and often the market's purest risk barometer. While equities pushed higher this week, Bitcoin lagged and struggled to attract the same enthusiasm. Price stayed above its 50 days moving average, so the trend did not break, but momentum clearly cooled as volume continued to fade. In a week dominated by cautious optimism rather than outright risk chasing, that divergence mattered. The message here is simple. Crypto was not leading risk appetite, it was watching from the sidelines. Digging deeper, the falling volume on Bitcoin is the tell that really stands out. Even without heavy selling pressure, fewer participants stepping in shows conviction was missing during this equity rally. In a market that stayed calm but selective this week, that lack of follow-through reinforces the idea that crypto risk appetite is still on pause rather than accelerating. Zooming out for context, the pullback timing chart shows Bitcoin is already extended relative to its recent correction cycle. That does not mean a sell-off is imminent, but it does highlight how little room there is for disappointment if risk sentiment cracks. In a week where markets stayed upbeat yet cautious, this backdrop explains why crypto traders stayed defensive rather than aggressive. Switching gears to rates, this is TNX, which tracks the US 10 years Treasury yield and sits at the heart of every macro trade. So, after the soft jobs data this week, yields compressed into a tight squeeze rather than breaking down, showing markets were cautious but not rushing into a recession call. The chart reflects that tension clearly, with volatility drying up and a breakout building as traders reassess the path for rate cuts. In a week defined by calm nerves and constant repricing, bonds told the story of patience, not panic. Looking beneath the surface, rates volatility is coiling hard, with a clear squeeze showing just how compressed expectations became this week. So, when volatility dries up like this after heavy macro repricing, it usually signals the calm before a directional move rather than lasting stability. In the context of cautious optimism, the bond market is quietly warning that the next data shock could land much harder than recent ones. From another angle, the extremely low ATR reading on the 10 years yield shows just how quiet this market became after the data shock. Moves have been shrinking, not expanding, which tells you traders are waiting, not relaxing. In a week defined by cautious optimism, that kind of calm is less reassuring and more like tension building under the surface. On this first chart, GLD, the SPDR Gold Shares ETF, is still riding that bigger uptrend like it owns the place. The Golden Cross context is basically the market screaming that the long-term trend is still pointed up, even when the weekly macro mood feels jumpy. And that matters, because in weeks where traders are second-guessing rates and growth, gold does not need hype, it just needs steady bids. The message here is simple. Pullbacks have not broken the structure, and the trend is still doing the heavy lifting. The MACD turning higher is the momentum confirmation traders wait for. When the MACD and signal lines start curling up and crossing, it is often the first clean hint that the next leg can actually follow through. Think of it as the engine catching again after a choppy stretch. If price is the story, MACD is the soundtrack, and right now it is starting to sound constructive. And on the trend channel view, the big takeaway is stabilization. Instead of sliding down the rails, GLD is holding inside the channel and respecting the regime, which is what you want to see if the uptrend is real and not just a one-week fluke. That kind of behavior fits a market that is still risk-on at the surface, but keeps a nervous hedge in the background. And while gold stays supported like this, keep an eye on crude too, because oil trying to carve out a base after a longer slump can easily become the next macro catalyst. On this TTM squeeze chart for WTI crude oil futures, volatility is getting crushed into a tight coil. That is the kind of setup where oil can go from sleepy to savage in a hurry, so the next breakout matters more than the last few candles. Then on the Fibonacci levels, you can see the obvious checkpoints the market will respect if the bounce keeps building. Those retracement zones are where rallies either snap through and run, or stall out and roll right back over. All right, let's talk about volatility, or more precisely, the lack of it. What you're looking at here is the VIX, and the message is almost eerie. For weeks, it stayed pinned below 20, grinding lower while the 50 days average rolled over. That's not fear, that's comfort. But notice the pattern. Every spike gets sold fast, and the ATR underneath collapses right after. Volatility flares up, then immediately gets crushed again, telling you traders are reflexively fading risk, not hedging it. This kind of prolonged calm doesn't mean the market is safe. It means positioning is crowded and protection is cheap because hardly anyone thinks they need it. Historically, that's when the VIX becomes dangerous. Not when it's high, but when it's boring. So this chart isn't screaming panic. It's whispering complacency. And in markets, that's often when the real shock shows up unannounced. Next up, the economic calendar is about to crank the pressure right back up. On Tuesday, January 13 at 1:30 p.m., the market gets CPI with a 0.3% month-over-month estimate, matching the prior 0.3, and 2.7% year-over-year, also matching the prior 2.7. Core CPI is expected at 0.3% month-over-month versus 0.2 previously, and 2.7% year-over-year versus 2.6 previously. So even a small surprise could whip rate expectations around fast. Then on Wednesday, January 14 at 1:30 p.m., it is a stacked block again with retail sales expected up 0.4% month-over-month after zero, plus the retail sales control group right after a prior 0.8. You also get producer prices ex food and energy in that same window, and with all of these marked high impact, traders will treat that 1:30 p.m. slot like a live wire. Bottom line, this is the kind of two-day macro combo that can either calm the bond market down or reignite the panic in a heartbeat. This week, the market looked confident on the surface, but underneath it traded with real nerves. The jobs data pulled rate expectations back into focus, and every new data point suddenly mattered again. Policy surprises in housing and fresh geopolitical tension in oil kept hedging demand alive, even as risk appetite refused to die. Add lingering tariff uncertainty, and the result was a market leaning forward, not relaxed. The takeaway is simple: optimism is still there, but confidence is fragile, and the next data print has the power to change the mood fast. See you next week. If this helped, hit like and subscribe. Have a nice weekend.